Do you also find yourself struggling with the drawn liquidity and establishing a proper bias? Well, then this video will help you out. Now, while I have previously made a video on this very matter, I decided to make another one and a more detailed one because it is just too important for me not to. But why is it important? Why is the drawn liquidity important and why is the bias important? Well, us ICT traders always want to trade within our bias, right? It just makes your trades higher probability. There's no reason not to. You could kind of compare it to retail trading, always following the trend. But in order to establish a proper bias, you must be able to recognize the drawn liquidity consistently. And that is exactly what I'm going to try and teach you in this video. So let's get into it. All right, here we are on the charts. Imagine this is a one-day chart, right? Where do you think the drawn liquidity is from here? Probably buy side, right? But why is that? I'll tell you why. We just took out sell side down here, right? We just took out sell side liquidity here. And what did we do? We violated a bearish P array. Previously, we respected them. Now we violate them. If there's only one P array in this leg, bearish P array, I am now extremely confident that we take out this high or at least hit the next P array, right? But generally, I'm very confident that we take out the high. And if we don't, we at least hit the next P array, right? So in order for these three equal highs up here to actually become my next drawn liquidity, I would need to have a candle closure above the next fair value gap, right? The one PD array that is closest to the equal highs. So right here we have a fair value gap. As soon as this gets closed above, if there's no other PD arrays here, this is now my drawn liquidity, okay? Because we closed above this gap, violating it, indicating that the draw is still higher. I want you to understand that if we are respecting bullish PD arrays on the higher time frame and violating bearish ones, the draw is probably higher, right? And vice versa. If we are violating bullish ones and respecting bearish ones, the draw is probably lower, right? So a violation of a bearish PD array with equal highs, I mean, it's pretty obvious now, right? But let's look at a lower time frame. Right, this is an hourly chart, right? A 1 hour time frame that I want you to look at. Imagine this is the exact same chart as the 1 day, just on the hourly, right? Now, where does it look like the drawn liquidity is? Down here, right? Why? We just took out this high right here, right? We respected a bearish P array and violated a bullish one, right? Now, my drawn liquidity is bearish, right? But we were just bullish on the daily. This is why it is so important to also look at the lower time frames, because the lower time frames can look very different from the daily or the weekly or the monthly, right? You cannot just look at the weekly and say, okay, the weekly is going up, I'm bullish. No, right? So I am bullish longer term because of the daily time frame, but shorter term, maybe in the next hour or two, I believe that we're going to go down here. So in the next hour or two, or until we take out these lows, I'm going to look for shorts, right? Even though I'm bullish on the higher time frames, I could still be bearish on the shorter time frames, or the lower time frames, sorry. Right? Because they can look very different. But again, same thing. We had a liquidity sweep. We are respecting a bearish PD array. We violated a bullish one. Now my draw is definitely these lows, unless there is some sort of fair value gap or order block or whatever here. That now becomes my drawn liquidity, right? Because once we violate this, I am extremely confident that we go to the next PD array, right? And if there's no PD array, I'm very confident that we go to the lows. Now, let's say that with a fair value gap here, what would I need in order for me to be very confident that these lows are going to get taken out? A closure below this, right? So what would I do if I look for shorts right here? My target would be this PD array, right? If we close below here, my target would now be these lows, right? So it's all about what PD arrays are we respecting, which ones are we violating, and you must take all time frames into consideration, or at least the higher time, like you could have a different bias on the hourly than on the daily, right? So make sure that you look at the hourly, 4 hour, daily, we look at them all, right? But understand that you may have different biases on the hourly and the daily. Okay, even though that, okay, this is my draw on the daily time frame, right? And this now is my draw on the hourly. So this right here, this gap right here has to get inversed before this now becomes my draw on liquidity on the hourly, if you understand what I'm saying, right? So maybe something like this, a sweep here, right? And then maybe we violate a few hourly gaps here, PD raise, right? As soon as this gap gets closed above, this now becomes my draw on liquidity, right? Even though this was always my draw on the daily, I could have a shorter term draw, right? Shorter term bias on the lower time frame, like the hourly. But let me try and explain it on a real chart, because that might make more sense and is also better practice, right? So let's jump onto a real chart. Okay, I'm gonna try and keep this short and simple. This is the daily time frame on NQ. Now we have a bullish gap here that we are holding, right? We just took out equal lows here, and we took out this low right here, and we're now holding a bullish gap, right? And if you look even closer, there's a bearish fair value gap right here that got violated. Why did it get violated? We closed above it, right? As soon as we close above this, we are now violating bearish PD rays and holding bullish ones. So now my drawn liquidity is here. This is a PD array high, and just like I mentioned that equal highs and equal lows are important, so is PD array highs, right? They're very good targets for your drawn liquidity. So this is now my target for the next day, and I'm very confident that this is going to get hit. And once you look at that, the very next day we hit that high, right? All because we are holding a bullish gap. We took out some sell side, right? And now we are violating a bearish one. So this is now my draw, right? It's just very simple. I can show you another example here. We have a bearish gap again that we closed above, right? We violated it. So now where's my target? No, it's not this high. Why is it not that high? Because there's a PD array in this leg before that high. And what's that PD array? This order block, right? So now this order block is my next draw. This is where I believe that the market is going to go to next. So the day after this, I would be looking for longs because I believe that the day right after this is going to hit this order block. And as you can see, we hit it perfectly, right? Very simple. We're just violating bearish ones. As soon as we violated this one, my draw now became that order block, right? But you could also establish, as I mentioned, a draw on lower time frames, right? This is a mistake that I made a lot back in the day. I would be so stuck on my daily or weekly bias, right? Maybe I was bullish on the daily time frame, and then I would only be looking for longs the following days. Now, while my daily bias may be correct longer term, there could easily have been short pullbacks in here, right? Or consolidations on the lower time frames during this green candle here. Even though the bullish bias was correct, I could still establish some shorter term bearish biases. Even though my daily bias was bullish, maybe my 5-minute bias is bearish, right? It'll make more sense when I show you. So let's look at some examples. Okay, great example here on the 5-minute on NQ, right? Maybe my bias is bullish on the daily time frame, but we just took out buy side here, and what happened? We closed below this bearish gap, right? So we took out buy side, we closed below, bullish gap, we closed below the bullish gap. So now my next draw is this low right here, right? So let's see what happens. Let's place our short right at the violation of that gap and target that low right here. And there we go, right? The draw was even lower. So what you could do is, if you're not satisfied with this RR, move your take profit to here, stop to break even here, right? But shorter term bias, right? All because took out buy side, violated the only PD array in the leg. Let's go for the low, right? Very simple. Let's look at a few more examples. Right here is an example of a 15-minute draw on liquidity. Now keep in mind, my bias may be bearish on the daily time frame, but this right here, right, because we are violating this bearish PD array, we just took out sell side. And if we look closely, I think, yeah, we are also still holding technically this bullish gap, right? Because we never closed below it. So my short-term bias is now what? No, it is not this high. It is now this gap right here, because that is the next PD array in the leg, right? So this gap now becomes my drawn liquidity. So what I would do is go on the lower time frames, maybe the 2-minute or the 3-minute, and then I would look for an entry, right? So what do we have already? Looking at it, we have an order block here. We could use that as our entry with stop maybe at the equilibrium of that fair value gap, and target that PD array that we found on the 15-minute. Now let's see if we can get filled. We did, and there we go, right? So this trade only won because I figured out the drawn liquidity on the 15-minute time frame, not the daily, monthly, or weekly. You know, maybe my daily time frame was bearish and my 15-minute one was bullish, right? If I want to find a lower time frame trade, I would advise you to look for lower time frame drawn liquidities, right? Huge problem for me back in the day. Being stuck on higher time frame biases will make you lose, okay? Just because you're bullish on the daily does not mean that price is just going to rally up all day, okay? It's going to have pullbacks. It's going to have shorter term bearish biases or drawn liquidities. And your job is just to find them, okay? I just showed you one. We can go over it again. Why did this work out? Took out sell side, holding a bullish gap, violating a bearish one. Now my target is the next PD array. Had there not been a gap here, right? Had it looked like this, right here, this right here would have been the target, right? Now there is an order block here, right? But I don't really pay a lot of attention to order blocks. I do, but not when I'm talking about drawn liquidity and bias. Just inefficiencies and high and lows, okay? So had this gap looked like this, right? There's no gap now. That would have been my draw. But because there was an inefficiency, that is my next draw. And as soon as we close above this, I'm very confident that we're going to hit it. And we did, right? So let's look at a few more examples. All right, this is a 4-hour example. Now, right here, my bias is definitely bearish, and I'll tell you why. Would you look at this? This gap got violated, right? We closed below it. So where's my next target? This low right here, right? Also, this is kind of a market maker sell model. I have just made a video on this if you don't know what it is, right? High time frame PD array hit. Some sort of consolidation here, right? Respecting bullish PD arrays, respecting them, smart money reversal. We start to go down and violate all those bullish PD arrays, right? So we violated the bullish PD array, right? The bullish fair value gap. Now my draw is lower, so I would go on the lower time frames, like the 5-minute, and I would look for an entry, right? So let's see if there is any. So on the 5-minute, there was this gap right here. So that is somewhere that we could place our entry, right? Maybe stop here and then target that low all the way down there. This is not something that I would typically do. This is a very long trade, something that I typically don't want to be in, but we'll see how it plays out anyway. So this is some very, very long trade. Not something that I would be in. Let's see. All right. So as you could see, there was take profit. Now we got very, very close to getting stopped out, right? But it worked out in our favor either way. Now what you could do is, you know, study it a bit more, right? I just took whatever I just saw, right? Maybe, right, we have all these equal highs being made. Right here, we are violating two 5-minute gaps, right? Violated this. We could use that as an inversion, right? Stop above the high and target this low down here, and that would have worked, right? A bit faster. But that does not really matter. All that matters is you know where the draw is because of the 4-hour time frame. It was lower, right? Why? Violating very speedy arrays, holding bullish ones, right? This order block held very nicely. This bullish fair value gap did not hold very nicely, right? So now my draw is here, combined with the market maker sell model. I mean, it's just textbook, right? But let's look at a few more examples. Okay, one last example before I jump off. I'll show you how simple it is. Okay, just look at the market structure. We took out these two equal lows. What happened after that? We are holding a bullish gap, right? What do? Violated a bearish one. Where's my draw now? This high here, right? It's almost a guarantee that we're gonna hit this high now. And it may not seem like a lot, but on the lower time frames, this is fine, right? So let's jump to maybe the 3-minute. This got inversed at 11. So let's find 11. That's right here. That is when the hourly candle closes. This is exactly when it get inversed, right? So what do we do now? We look for an entry. We have a fair value gap right here. Very, very small one. Let's see if we can get filled on this. We'll put stops at this low, target that high, right? So let's see if we can get filled. And we did, right? And we hit TP in an instant. This is not a very long trade. This is a short-term scalp. As you can see, this was a 6-minute trade, a 6-minute drawn liquidity, but we made money off of it, right? Off of this very, very, very short-term bias or drawn liquidity, right? So daily time frames are great for looking at a little bit longer term drawn liquidity, gives you a general idea of where the market is going to go over a longer period of time. But I really want you to get focused on these shorter term drawn liquidities, because you're going to miss out on so much money and you're going to get stopped out going long because you found a bias on the weekly or the monthly or whatever. Right? I just want you to focus on shorter term biases as well, right? Or drawn liquidities, because this was, again, a huge mistake that I made. Just got stuck on my weekly bias or my daily bias, which cost me to lose a lot of money, right? And I don't want the same happening for you. And this was the, I guess you could call it the holy grail for me when it came to, drawn liquidity. And I just explained to you basically what I do every day, and it works perfectly fine for me. So I hope you enjoyed, and I hope you learned a thing or two. This was a very raw and not very professional video, so I apologize for that, but I still believe that I gave out the information that was needed. Very, very valuable information if you ask me. So I hope you enjoyed, and I hope I'll see you in my next video. And until then, stay blessed, and bye-bye.